Welcome to Multiple Perspectives. I'm David Lofgren. Real estate has long been a cornerstone of wealth building, and multifamily residential real estate is often the first sector for investors to explore. But navigating this asset class in the shifting economic climate of late has been, at best, fairly complicated. Fluctuating interest rates have led to unpredictable outcomes, and evolving trends are forcing investors to rethink their strategies. Joining me today is Scott Trench, CEO of BiggerPockets and co-host of the BiggerPockets Money podcast. As an investor, entrepreneur, and author, Scott has helped millions of people unpack how and why real estate investing can be such a powerful part of your portfolio. Today, we'll explore the macroeconomic forces shaping multifamily real estate and uncover strategies for success. Scott, welcome to Multiple Perspectives.
David, thanks so much for having me. Excited to be here.
As CEO of BiggerPockets, you sit at the center of this fairly sizable community of, thought leaders, publishers, investors, folks who are, let's say sort of real estate investing curious. This means you have a uniquely well-informed perspective on the world of self-directed real estate investing. You yourself are a real estate investor. You've written books about achieving financial independence and the process of purchasing sort of single-family homes. I'm curious, from your vantage point, how is the average sort of sub-institutional, if we want to call them that, real estate investor doing heading into 2025? The last few years have been sort of a wild ride for this industry.
I think they're doing terribly. I think this is an absolute disaster. A huge crash is in progress right now. People have lost all or most of their investment in so many cases for probably the majority of deals purchased between 2019, 2020, and 2022 at this point. I think we are... I think that there's reason to ask, are we at or nearing the bottom? I don't know if this is, whatever the curve for valuations in multifamily is, you ain't buying at the peak right now if you're buying a new one. So I think it's an absolute mess. And the people who are getting hurt in this are typically millionaires who are accredited investors who have put their cash in place, and these potentially high ego, very kind of influencer style general partners who raised a bunch of capital and are trying desperately to preserve their reputation and see what's on the other side of the current economic pain. So I think it's an absolute disaster, and the chickens are coming home to roost here in 2025. And I can't decide if right now or 6 months or 12 months is the right time to buy in terms of being at the bottom, but it's clearly close or at that time. Given what's going on in the market. That's what I'm seeing. I don't know how you guys feel here at Multiple Perspectives, but that's what I see.
Yeah, the thing that we constantly are preaching, of course, is diversification. I think that sort of anyone you talk to who has anything to do with personal finance or investing will always start there, right? That being said, it's kind of hard to say if there, in retrospect, would have been a great path from just before the pandemic to now. Do you feel like, there is anyone who sort of had the ability to read the right tea leaves or was able to sort of say, if you invest in this way, or if you followed my advice in 2019, 2021, whatever, you should be okay right now?
I think almost everyone who didn't invest in commercial real estate is doing fantastic right now. If they invested, besides those folks, right? If you were in basically any other asset class, you crushed it. If you were in gold, you crushed it. If you were in Bitcoin, you crushed it. If you're in the S&P 500, you crushed it over that 5-year period. You didn't have a party the whole time, but you had mostly a party. The people who are getting wrecked are the people in the commercial real estate market, specifically office, specifically multifamily, as the forefront of this kind of devastation that's going on here, kind of fairly quietly still relative to other parts of the market. But I think basically everybody else did great. If you were in single family rentals or small multifamily, like the duplex, triplex, quadplex space, you probably also squeaked by. You didn't get super rich from 2022 to now. Maybe you went down a little bit, but you haven't experienced what I think can't be described as anything other than a crash that's happened in the commercial multifamily space. So when you talk about diversification, yeah, I think As long as you were diversified away from commercial real estate, you did well. But diversification within commercial real estate is still not saving really anybody in that space right now. Most people who bought anywhere in that 2020 to 2022 range are probably going to get crushed. You're going to see a few outliers, but the story won't come until they have to refinance or sell. So
sure. And as we know, there are a lot of refis coming, right now through the next couple of years. It's likely that we'll still see a lot of those sort of the tide going out, as we say.
Yeah, I mean the problem with the space is that all these people lost all their money. Think about this in multifamily, right? So multifamily, the rents have gone down a little bit year over year, 2024 versus 2023 in most markets in the United States. The places where the most volume was happening for transaction were like the Southeast and the Sun Belt, where a lot of these, like the party was going on Instagram influencers, for example. You think about people. I love to pick on Austin, Texas, because it's just such a classic example of kind of groupthink and this popularity thing. Like the biggest influencers and the biggest names in the space all bought at the same time in 2021 in Austin, Texas, right before the supply peaked in that market. And now everything is going wrong. Interest rates are way up, which just crushes you regardless of anything else that happens. Rents are way down because they have so much new supply. A 10% increase in new supply in Austin, Texas, in 2024 versus 2023. That's an absurd onslaught of supply, and it will be very high this year as well in 2025. And then you have the expenses going up, which are just killer. When insurance policy goes up, it just completely wipes out the cash flow for whatever that increase is, and there's nothing you can do about it, which means it comes straight out of the valuation for one of these commercial real estate properties. And so that's just a complete bloodbath in some of these markets. Now, in 25 years, that'll be noise. Austin will surely do great, but most people in the commercial space are not capitalized to survive for 20 years, even if they say they are. It's just not the reality of it. Few folks buy real estate and can actually handle a 40% decline in asset values on that. That wipes out a 70-30 equity debt to equity position and a 60-40 debt to equity position, which was private prior to this market considered conservative. So I think folks I think it's really bad.
Well, and at BiggerPockets, I mean, you guys are largely focused on real estate as the investment that you are, sort of helping people navigate. How have you been talking with the folks who are, reading your publications, listening to your podcasts? I mean, how are you coaching folks through this time that feels like, gosh, what happened? It looked like things were going to be so promising for a little while here.
Well, I mean, we've been talking about this problem for the last 2 years incessantly, over and over and over again. You can read my publication in 2023 and 2024. I'm going to come out with another one here in 2025. We have this is not a surprise that the valuations have been going down. It was hard to see in 2021, for example, but by 2022, the writing was on the wall with all of this. So we've been talking about that. We've launched a large number of economic commentaries around this. And I think the answer is be patient, be cautious, invest in things you can control, put a minority, very small minority, 10 to 15% maybe of your position into these syndications. Do not put all your eggs in one basket, even if everything looks great on that front, because it is a surrender from a control perspective. And we just launched a new product called Passive Pockets to help expose this industry and look for the good opportunities. And on the flip side of that, there's a reality of in this terrible environment that we're in. I don't know if we're at the bottom of this or if there's a lot more pain to come in the space. But again, it's coming up on buy time. I think if you had, if you're an accredited investor of the type that could be potentially investing in these syndications, and you start dollar cost averaging now over the next 2 years, you might be investing right now at the bottom. You might be investing at the bottom in 6 months or 12 months, but you're clearly going to be entering at a pretty good point in the cycle around this. So I think that the other part of it is to talk about when the tide starts turning or when you're nearing the bottom and how to think about entering back in. I think we're right there in terms of the market conditions right now.
So, I mean, correct me if I'm wrong, but I think of the BiggerPockets audience generally as folks who are engaged in a more sort of direct investment
That's right.
strategy.
Yes.
There's a lot of the sort of BRRR, a lot of the fix and flip. A lot of this sort of like building your own small portfolio or trying to figure out how to sort of make plays on these tangible assets that maybe are down the street from you, or maybe you're doing a little bit more sophisticated work to try and vet and discover in other markets.
Well, we have an interesting dynamic with BiggerPockets because our members all start the way you described, right? Like my journey is not atypical of a typical member. I joined in 2014, bought my first property, invested steadily for 12 years or 10 years, 11 years, whatever that is, here, and became over that time period an accredited investor. And while I continue to like buying properties as a major component of my portfolio, a lot of people decide after they become millionaires by buying a couple of properties and waiting 10 years, hey, I don't want to buy my fourth duplex anymore. I would much rather get exposure to real estate. There's something more passive than that. And that's when they begin thinking about investing in these syndications. That became very popular in our platform over the last couple of years because a third of our members are now millionaires. Right? 29% of our members in our most recent survey are accredited investors. So we define that as millionaire or earn over $200,000 a year. So that's now a major slice of our audience, and our audience is evolving because they've been successful over the last several decades into this kind of yes, I'm still interested in a great deal on duplex, but I might also be interested in a high yield, totally passive return if I can really get comfortable with that concept. So that's why we've been really exploring that and launched Passive Pockets in Q3 2024 to address that need.
Okay, so talk to me about this concept of dollar cost averaging, because it's something that, oftentimes in the context of, say, the public markets, people will talk about buying into stocks or trying to dollar cost average into, these sort of more easily understood, more less sort of like readily discussed asset classes. But you're talking about this in a real estate context. Obviously, you can't do this by dollar cost averaging your way into duplexes, unless you have a ton of money to be putting into duplexes. What do you mean by this? How are you trying to help people understand taking this approach, maybe say over the next few years?
Okay, well, let's look at the multifamily market, right? Let's just discuss it from a macro perspective, right? Investors have learned or should have learned that when you invest in a multifamily syndication that claims to be safe and projects at 18% IRR, that you can, and every decade or two will lose 100% or close to it of your investment. Okay. When you invest continuously into an asset class that can wipe you out, that is not a winning strategy for this. So there's an element of market analysis that we now know we have to bring when we think about the multifamily commercial real estate market here, or you need to be thinking about it as a very tiny piece of your portfolio. When we think about what would cause the multifamily, this is market timing at its core, right? I think if you're going to be investing in multifamily on this, and you don't want to do it in a very safe, very low leverage environment like a REIT, and you want to do it in one of these private syndications, you have to have this concept of, yes, I'm having higher risk and I'm chasing higher returns for it. So what would cause the bottom and what would cause growth in the multifamily sector here, right? Well, I think you have to have an opinion about three things in order to make a quality decision that you believe when you're looking at a multifamily opportunity. The first is you have to have an opinion on interest rates. That's anybody's guess, but you got to have an opinion. You got to understand the risks on there.
And you mean to say an opinion on what direction they might be heading, how the Fed might act, et cetera?
That's right. Yes. So I'm going to be completely wrong on this, but my opinion on interest rates for 2025 is that the Fed ain't going to be lowering them very much, and that there's a risk at this point that they actually raise them by a little bit. And the number that you have to know about in this industry, if you want to get into multifamily investing, is the 10-year. The 10-year Treasury is a huge core metric for this industry because a lot of government-sponsored entity debt, like Freddie Mac debt that is used to purchase multifamily apartments, is pegged directly to the 10-year. So if the 10-year goes up, so do the borrowing costs for multifamily operators. So when you have the 10-year is like at 4.8% as of January 14th, Tuesday, January 14th, when we record this. I think it was 4.79 when I last checked. So I check frequently because it's so critical to what we do.
Right.
But the problem is that this is only a 40 basis point spread to the federal funds rate, or 50 basis point spread. It usually, in a historical context, is about 150 basis points higher than the federal funds rate right now. So if you're a multifamily operator and you're listening to this, you're terrified. You're like, what the heck? No way. We're not getting to 6%. Well, that's actually 5.75%. We're not going to get up all the way up there. Well, that's what the market would call for in a historical context. And they have not been able to believe the rate that the 10-year has risen at over the last couple of years. And I think we at BiggerPockets have been like, this is a very realistic outcome to be sitting here at 4.8, approaching 5% from a 10-year perspective. In the middle of last year, we're sitting there with a 10-year of like 3.8 or something, and the federal funds rate's 4.5. And you're like, for the 10-year to sit at 3.8 in 2 years, the Fed's got to lower rates 10 times. The only reason, if you're thinking about this, why the Fed would lower rates 10 times, because you have a recession or depression so bad that millions or maybe 10 million people are out of a job. And in that situation, your real estate value ain't doing well either on that front. So it's like a heads you win, heads you lose, tails you lose situation for rates in that context at that point for multifamily for this. That said, I think where we're at now is we're not going to see the Fed raise rates a bunch. You might see them hold steady here, and they might raise it a little bit. But even one raise, or the threat of one raise, is going to cause that 10-year to reset and jump to probably 100 basis point spread to the current federal funds rate. So I think you're sitting here with a real risk of this 10-year going above 5, or between 5 and 5.25, and sitting there for a big chunk of 2025. And that
which
is going to be
will have a direct impact on mortgage rates and lending at rates. Yep.
Yeah. No multifamily syndicator, none of them that I've talked to, is telling their investors that when they refinance in 2025, the 10-year will be at between 5 and 5.25. And that is going to be very bad news. So on the one hand, if you think about market timing, that kind of like Q3, Q4, 2025, Q1, 2026 time is when I think you're going to see a lot of, as I said earlier, chickens come home to roost for some of these multifamily operators. So if you're really trying to time the market, like I'm going to be ready. I'm going to be poking around and being ready for that moment in time. But so that's on the interest rate side of things.
Sure. And you said there are 3 things that we need to keep in mind. Okay. Have an opinion about
interest rates. Supply is the second one. I like to start with supply because interest rates, all that is a guess. I'm predicting the psychology of the Fed. I'm predicting the consumer, the CPI, the producer price index. All these different things go into that analysis there, and I'm going to be wrong. People are going to laugh at this later in the year around that. Supply, it's impossible. It's very hard to be wrong, right? When when someone wants to build a new apartment complex, the project usually is a 2 to 3 year cycle from idea to reality at minimum. So the supply that's going to hit in 2025 started 2 or 3 years ago from a process perspective, sometimes 4 years ago. And we know it's going to hit. Now, the timing, some of it could be shifted in 2024, some of it could be shifted in 2026 technically, but we know that a bunch of that's going to hit nationwide in the first part of 2025. And we know that inventory is going to hit disproportionately Sunbelt and Southeastern markets. This supply is not coming online in places like Chicago. It's not coming online in places like Baltimore, Maryland, which are going to be relatively insulated from that. It's going to come online in Austin, Texas. It's going to come online in my hometown of Denver, Colorado. It's going to come online in Phoenix. It's going to come online in Atlanta and some of these other Sunbelt markets. So those places, when you see a high percentage of your existing inventory, of your existing multifamily stock, for example, coming online, that is a threat to multifamily. That is capitalism working and the standard of living for everybody increasing at the expense of the people who own multifamily or are constructing it in there, on there. And again, that this is not like just a guess. This is a very easy to predict and very easy to kind of look up situation for this. So I think in the first half of 2025, you're going to see somewhere in the ballpark of 500,000 new multifamily units. In 2025 total, you're going to see about 500,000 new multifamily units hit the U.S. market. That is a very high number but it's not a record. The record was set last year in 2024, where we're still finalizing data, but I think it will come in just shy of 600,000 multifamily units delivered. So that is going to keep rents from growing. Now, notice that the good thing here is rents didn't really decline much in 2024. They just didn't grow. I do not think rents will decline substantially nationwide, although they will decline maybe a little bit more in some markets around the country that are seeing a bunch of this supply. But rents should be skyrocketing because interest rates have come up so much over the last couple of years. When interest rates go up, rents should increase because the alternative to renting, buying a home, is so much more expensive. So once that new supply stops, if you have a 3 to 5 year outlook, I think rents will grow pretty dramatically in those out years. Like I think 2026, second half of 2026, 2027, you could see really significant year over year rent increases on average in the United States. And for that to be more extreme in some markets, like I bet you Austin, Texas, for example, will make up a lot of lost ground in rents in 2020 that they haven't seen growing in the last couple of years in 2026 and 2027 because of this dynamic once the new supply onslaught abates on that front.
And so talk to me for a minute about why we shouldn't be expecting that sort of new supply trend to continue into 26, 27. Like what are the factors that
starts are down? It'll be almost impossible for the country to deliver more than about 260,000 multifamily units in 2026 based on the current start activity. So we can know that pretty well. You can look this up. You can Google it.
And that's a basic metric right.
Yeah. So, you can look this up from a variety of sources. You'll find that number to wobble a little bit depending on which source you look at, but it's not going to be, it's going to be close to 500,000. It's going to be close to 250 in 2025 here and closer to 260 in 2026. And you'll find a few people who will disagree with that. So supply is easy in the sense that we just know that, and you can look it up for your market and kind of get that answer.
And it's a very long tail metric, right?
Yeah, and it's like people don't start construction projects and abandon them unless something really bad happens, in which case we're all off, and people are going to abandon projects midway through construction, and there's going to be buildings that are half finished. Like that's a disaster. That's such a disaster that it'll be so rare that we don't have to really plan for it in the analysis there. You just lost all your money no matter what in that case if you invest in multifamily.
So barring that, we've got our opinion in interest rates. You said, we have an opinion on supply, but in some ways you're saying it doesn't even really need to be an opinion. You just have to be able to find the new starts rates historically and plan out a year, 2 years from there.
Yeah. And then the last piece, of course, is demand, right? And why I like this is interest rates are a guess. Supply is easy. And demand is one of those things where I think you can spend 30 years trying to perfect your forecasts and still be wrong and surprised at the end of the day around it, right? Now, one of the best correlates for long-term supply is new construction. Like there's no doubt in my mind that over the next decade or so, people are going to move to Austin, Texas. They're going to have net inbound migration there. They're going to move to Tampa, Florida. Down there, you're going to see that people don't develop billions of dollars of real estate based on complete crap. From a demand side forecast, right? It's just that putting it all together for interest rate, supply, and demand is where it gets really tricky, and a lot of people are going to lose their shirt from certain projects. But one of the things with demand that I think is tricky is let's use the South. Let's continue picking on the South for Florida or Texas markets that are getting crushed right now from a demand perspective, right? A couple of years ago, everyone's talking about how, California, the politics, the whatever, you're going to move to Austin, Texas, you're going to move to these business-friendly environments or whatever. That's great. People did that. There's truly net migration moving there, and that will continue. But I worry that some of those forecasts are overblown or overly optimistic, and I think that there's going to be a seesaw effect. And I'll use this as kind of humorous example here of you move to Austin, Texas from Southern California, and Austin, Texas has seasons. It can snow, it can freeze there. It gets really hot and humid. It's a wall of water in the summer. When you go to Austin, Texas, and you live in Southern California or where I live in Denver, you realize there are bugs. There are very big insects that are very unpleasant in Austin, Texas and in Atlanta and whatever. They are very loud. Like you go outside, it is very loud at night. in these areas. If you're anywhere, if you have any trees or shrubbery, if not whatsoever, it is a different environment, and you may be fine with it, and your spouse may not be, and you're moving right back to wherever you came from here. And I think that demand dynamic is not going to like lead to net outbound migration coming from these places. You're still going to see more inflows than outflows, but but I think that there was a little bit of over optimism in some of these markets here. And then last, you have the expense side, which we all know the weather patterns that are changing down in parts of Texas, Florida, and the Southeast are obviously causing insurance rates to skyrocket, and that's also impacting other parts of the country. And that will have an impact on the pricing here too. So the demand is super hard, but I would just be cautious. I would say if you're going to have a demand, don't be overly optimistic about the demand side forecast. Be cautious and conservative. Now, if you like the multifamily space and you're worried about some of these things, again, like the easiest place to go into, the simplest one where you're probably not going to lose very badly right now, is to go to a place that has light supply, right? Like I'm people like to pick on Chicago because they didn't have a good 6-7 years before the COVID situation or whatever. But I actually think that's a great, potentially safer market here, because you're not seeing the rents being impacted because you're not seeing the new supply coming online like you are in some of these other markets, like Baltimore, Maryland. I grew up right near Baltimore, Maryland. I think they're adding less than 2% net new multifamily housing stock. Potentially a great market. So those are the three variables: interest rates, supply, and demand. Got to have an opinion on all three, but you should know that your interest rate opinion is always going to be a guess. Your supply is an easy one to know, and you'll probably never truly embarrass yourself if you just nail that supply number and make a decision.
You just have to do your homework, right?
Yeah. And then on the demand side, just know that the optimism about inflows can change over the next couple of years, and that can throw you off a little bit.
Okay, so let's say that the hypothetical investor that we're speaking to has developed these theories, has sort of created an opinion, developed an opinion on those 3 points. How would you advise someone? Because, going back to your previous advice, if we're going to try and dollar cost average ourselves into these markets, that means inherently we have to partner with a firm, a syndicator, a platform that will help us take our relatively small amount of money, and add it to a much larger pool. How would you advise investors to start vetting these partners? Because the truth is, especially if you are already an accredited investor, if you're hanging out in places where folks talk about investing all of the time, inevitably you will run into people who have chosen a multitude of paths, who are going through someone that their financial advisor recommended, someone else has a buddy that they play golf with that's, putting together a syndication. Like, how do you start to vet these options once you've developed your opinions on those core 3 concepts?
I think it's repetitions. I think I think there's no other answer for it than look at a deal, watch the webinar, or look at the materials, and then do it again, and do it again, and do it again, and do it again. And when you get, these things take 30 minutes to an hour, I think, to form at least a cursory opinion on around it. And I think you just put the time in. If you're an accredited investor, you're going to put a couple $100,000 into these things, probably should spend couple hundred hours potentially learning about it. And I don't think there's an easier answer for it, because how do you determine what I did this with debt funds a few years ago. Like I called up for a debt fund is another type of syndication here. Typically in the world of real estate and what in the world that BiggerPockets operates in, these are folks that make hard money loans to flippers in certain regions. Debt fund can mean anything, but not in our world. That's what I was looking at here. And it's like, okay, what's a good debt fund? Well, I called up 100 of these guys, and some of them are able to raise money, because some of these funds are 506C, and that means they can advertise to raise funds. And others are 506B, which means they can only raise it from people that they know or have an existing relationship with on there. Then there's like all these different variables. Like, what's the underlying loan structure they do? Do they have a high ARV that they're lending against? Do they have full recourse debt? Are they spread geographically? Do they do only first position, or do they do second position? Do they do major remodels? Do they allow first time flippers? Like, that is so complex. Like, what's the risk profile of the underlying loans? Then, do they have leverage? Is their fund levered? Is it all just, is they have $50 million in capital they lend out? Or do they have $25 million in capital they lend out with a $25 million bank loan that they have on there? Then that gets complicated. How do you assess risk? Then it's like, okay, well, who are the fund managers? Is there one guy who's the head honcho? And if they get hit by a bus, then no matter how good a due diligence you did and everything else, that's kind of screwed. Is the geographic concentration a good thing because the fund can go and take over the deals and that de-risks things? Or is it a bad thing because a hurricane and an insurance problem can wipe out asset values in that one market or whatever? Like, how do you make that call? And so it gets really complex. I don't see a way to make those decisions in a quality way. I mean, I'm probably confusing and overwhelming people just by saying this piece without just actually going through the effort of interviewing a ton of these folks and looking at a ton of different pitch decks and then making your decision. And I think multifamily investments are the same way, right? Do you want the what does good look like? What does bad look like? I think it's an art there. Yeah, we can have an opinion on it. I can give you mine for where I'd start, but it's hard fought and hard won, I think, one review at a time.
So, I mean, it sounds like the takeaway here is that, you're saying if you're going to be investing serious money in these projects, regardless of, whether you've done this in the past, if you have more experience with direct investment in real estate, or if this is sort of your first sort of dipping your toe in the pool, so to speak, that there are a few things we need to do, right? The first is figure out where you stand on those three key elements: interest rates, supply, demand. And some of that you can do your homework, and some of it you're just going to have to listen to read as much as you can and decide whether you're hawkish, sort of figure out where you stand. Okay, so we've got that. Second, treat it like it's a job, right? Like, take the time to do the research, to listen to the webinar, to sort of absorb enough, get yourself into the sort of milieu of all of these terms and discussions and these characters in these space, to feel like you have, a solid footing underneath you. Is there anything else? What's the last step?
Yeah, I'll say this. Like, when you're looking at the sponsors specifically, right? I'll give you two kind of high level examples, right? A sponsor that would be very attractive to me in a situation like this is somebody who's been investing continuously, but not too aggressively over the last 5 to 10 years. Even if they're going to have a loss or two because they bought at the peak in 2021 or 2022, that doesn't bother me if there's a continual pattern of investing. So someone in a Midwestern market that buys the same stuff that's super boring, super consistent, no change in strategy, they're going to have a couple of winners over 10 years and they're going to have a couple of losers. I'm fine with that. What I would be very skeptical of is somebody who got really big between like 2019 and 2022 and bought so much at that point and then has bought very little since then at that point.
Right.
That person, when they raise right now, are going to be going through absolute hell with their existing portfolio. There's going to be a whole bunch of misaligned incentives. There's going to be a whole bunch of pressures on that person or that fund. There's going to be a whole bunch of distractions. And I think they're going to be much less equipped to pull off investing in this set of opportunities than the former person. So that's going to be the real challenge for LPs in this cycle of investing, is to say, who should I, and by the way, there's going to be some fraud, but that's going to be a small part of this. There's going to be a few people that were real hucksters that are going to get exposed pretty early in this cycle. But I think that
as we've seen in previous cycles.
Yeah, but there's a difference between somebody who just made a huge bet, a whole bunch of bets, and is going to lose a lot of money because they bought at the peak, and a fraudster who actually stole money or misappropriated funds or really was negligent or whatever. And there's going to be a difference between that and somebody who had one or two bad deals in the context of a fairly steady Eddie approach on there. And there's going to be a few guys who avoided the entire cycle whatsoever who are going to really raise big money. And I don't know how you can parse out who's going to be the winner in that. But I think my favorite type of investment would be the steady Eddie person who continued doing what they've always done through the cycle, but didn't really take big leaps forward. I know that other people will be attracted to folks who just totally timed the market perfectly and sold right before and have been sitting on the beach for 2 or 3 years. Those will be hard to win. You always wonder what that really means. Is that really the superstar success in market timing and excellence, or is there something else going on there? But what I would stay away from are the folks that went all in 2019 and 2022 and now have to deal with that mess and are now trying to raise another fund on top of that. That's where I'm not interested.
Right. And I produce all the Q&As that we do with the sponsors for Equity Multiple. And it's interesting when you hear people talk about, we went through the 2008 crash and we came out the other side. Or the folks who say, yeah, this is our first deal in a couple of years because we've been waiting for exactly the right thing to come along. But they have a track record. You can sort of tell when someone is not the product of one smashing success, but rather the product of like a long and slow track record, as you say, steady Eddie, where you start to feel like, okay, this isn't about a flash in the pan.
Yeah, but be careful. Be careful. The guy who bought a bunch of properties in like 2021 and then hasn't bought anything for 2 or 3 years ain't your guy. That's
sure.
That's not the one that you want to be going with in this thing, because that was not a hard thing to do. At that point, the hard thing to do was to sell in 2021. Not buy in 2020 or 2021 when all the incentives and all of the market sentiment was there. I mean, there's some guys raising capital right now that have ads out and it's like, oh, all of our deals are like 25% plus full cycle IRR. Well, also you bought like $500 million of real estate in 2021. What's going on with that? Your full cycle deals, the ones you exited back then, were doing great. These ones are going to lose half of your equity. And you're bragging about your IRR. So this is why reps matter. And just you as a LP doing your work and looking at a bunch of these. Now is a great time to start looking at pitch decks. You're not buying at the peak anymore. You may not be buying at the bottom, but you'll feel more and more comfortable as you look at more and more deals. And that would be my advice to everybody is form an opinion on interest rates, supply and demand, and then look at deals. Just look at them over and over and over again.
Scott, this has been an incredible conversation. And I can't wait. I hope we get to do this again sometime in the future and we can talk about how this conversation compares with, reality. It's always a fun thing to do.
Yeah, come back and make fun of me in a year, see how things went. So, but for the record, I don't know what the bottom is. I just went under contract on a quadplex, small multifamily, last night. January 13th. We'll see if I actually close. I think I will on it, barring any gotchas. But whether or not I'm buying at the bottom, I'm definitely buying on the downswing of the cycle for this. So that I feel like it is time to begin re-entering the market in a meaningful way, and I'm doing so personally. I actually sold a big stock position to do that.
Money where his mouth is. Scott Trench, thanks so much for joining Multiple Perspectives.
Thanks, David. Appreciate it.
That's it for this episode of Multiple Perspectives. Thanks again to Scott for joining me. If you enjoyed today's discussion and you want to hear more of what Scott has to say about personal finance or real estate investing, you can find links to his work in the show notes for today's episode. If you want to learn more about the real estate investing opportunities we have on the Equity Multiple platform, we've got links for that too. Thanks for joining me once again here. I'm David Lofgren, and as always, you can let me know what you think of the show via our email, multipleperspectives@equitymultiple.com. See you next time.